All right. So we're going to get started shortly. We had a session last week. We got one next following. So if you're sitting, you're welcome back sessions. So and then I'm going to post right now. I'm going to post on here. I'm going to post this. This is the link to where you can find the PowerPoint for these talks, and all 4 sessions are already there, or 2 of them are there, and there'll be more coming as we get going. So you can find those sessions online. The PowerPoints are there actually in PDF files. So again, have your hands on or your mics on mute. If you're not, if you're listening, and if you have questions, you can put in a chat box for the Q&A. I'm going to get rid of this. And so here's our agenda, and we're going to talk today about all things tax. We're going to discuss different topics about taxing, whether you want to sell the assets, whether you want to gift some assets, or how you're going to transfer it, and what are the tax consequences of that decision of transferring. So there's lots of things to think about in this farm transfer process. I've got a hand up. Do we have a question? 2, let's see. If you have a question, you put it in the question or chat box or the Q&A, either one. So hopefully you can hear me. I don't see any real reason why I can't see anything for comments. Anyway, we're going to talk about these topics. Go back here. And so plan for today and make it work for what will be the future. Hopefully we'll live a long time. We never know the date we're going to die, but we're working on estate planning and farm transfer. We're figuring out what we want to see happen with our assets down the road. You can see we talk about different tools here. Basis, we're going to talk about basis this morning. It's a big tool. It brings a lot of interest around your tax consequences. We're going to talk about whether sales of part of your assets to the next generation or outside the farm are the good tool. Whether you can afford to gift anything to your heirs or not is another possible tool you can use, or just go through your estate and have inheritance for your next generation, and how you're going to deal with everybody, including the non-farm heirs. We'll talk all about those things. Nathan and I are not attorneys. We're not accountants, but we do have backgrounds. I've been doing these talks for over 20 years now. Lots of experiences, and we encourage you to have your team professionals. We give you ideas and get you thinking about different things. The last session was on goals. We want you to stay focused on what you want to accomplish, your goals, and then go and use these tools to accomplish that. So we encourage you to get a team, professionals set up to help you accomplish your plan. I would tell you all the farms are not the same. There's a lot of difference to different farms. Some of these materials might not apply to you, but they're general concepts that'll apply for hopefully everybody in your situation. Just think about how it might apply to you and your world. Well, estate transition goals are the foundation of your estate plan. So again, we want you to have if you can go back and look at those sessions or look at the recording from the first session, think about what your goals are, and then try to get them accomplished, and understand the financial ramifications of what you have in your goals will help you prepare for your meetings with your planning professionals. So you have an idea of what are the tax consequences of doing this, or if I gift this or I sell this, what does that mean to my situation? Succession involves the transferring the operation of the business, not just the assets. So again, farm succession, you've got to figure out, when am I ready to give up some control of the operation? When am I going to let them make some decisions, take over some management, different parts? I always had a boss that said, I'm going to give you enough rope to hang yourself. Give me enough opportunities to make some decisions, and then they're always there to help me. So that's why it works good when you have multiple generations to help. You've got that random advice sitting there right for you. Transfer planning is an additional process beyond the estate planning, where you want to figure out how you're going to transfer the operation, both the assets and the management. So both transition and estate planning involve questions of fair versus equal in the family dynamics. Our land values are enormously high right now, so it's pretty hard to treat the farming heir and the non-farming heir equal. I mean, some people can do that, but a lot of us maybe can't do that. We'll talk more about that as we go forward, but it's a fair versus equal dynamics is a discussion you have to decide what you want to do in your situation. Farm transfer, business management, labor, annual income, farm asset ownership. Those are the concepts you want to think about in the farm transfer. Again, transferring that management of the operation. And again, I always think it's like, well, it's really nice when I'm around to help with that, be an advice pattern and help move on, make their own decisions. how much? I was an ag loan officer for 9 years in dairy country, had 2 of my retired farmers. They both died in the dairy barn. And they were retired, but they were still working every day on the farm. So what do you want to contribute to your farm after you retire? Annual farm income. Again, did a lot of inlibs and extension, and annual income is really important. Is there enough for both generations? We were talking today about a business that has 4 families involved, and they were complaining about the money. It wasn't necessarily enough money for those 4 families. And then the farm asset ownership. Another big concept. I've had a gentleman who his wife called me every year for years and years and years, even in their 70s, and they were still working the farm with no assets. So, and then when the mom finally did pass, after dad passed first and mom passed, then the farming area had no control over his future. So you have to think about those things on the process as well. Farm and personal estate, personally owned assets often includes your farm assets, but there's some things that are kept outside the farm, but also includes your farm assets. So you want to have a personal estate plan as well. And even down to who gets the tea set or who gets the special silverware dishes or whatever. You've got to think about all those things on the process as well. So I think I'm here. I know that my cohort, Mr. Nathan Holinsky, take over here, and he's going to visit with you for a little while here.
Thanks, Dave. Hello, everyone. Again, I am Nathan Holinsky, and I'll be speaking for the next half hour or so about some of this farm transition topics. And I just want to reiterate what Dave just pointed out. Whenever a lot of people, when they start talking about the farm transition, they always go straight to assets. How do we transfer the land? How do we transfer the cows or the machinery? But Dave's, his slides before this pointed out, we need to transfer the leadership and management skills that the other generation owns before we start transferring the assets. If you give your younger family members all the machinery, but you don't teach them how to use it or manage it, it doesn't always end well. So I just want to reiterate that. But our discussion today is mostly on how to transfer these assets. And we can see on the screen here, right, we have 3 main transfer portals, transfer opportunities. Number 1 is sell them, right? You can sell the land, you can sell your machinery to either the next generation or to someone else unrelated to the farm. You can gift your assets, and we'll talk about the details of what goes into gifting and how to use this gifting mechanism to potentially help out. And then the last one there is through an inheritance portal, if that's through your will or some other inheritance mechanism that we'll kind of walk through as we continue on. And we just want to highlight there right at the bottom, each of these choices have different possible basis and tax consequences. And we'll talk about basis in the next couple slides. So if we slide on to the next one. All right, so again, we had this image kind of right away, right? Where we have, again, these 3 different options for how to transfer or how to get rid of some of the assets that you own. The top one there, again, sales, right? Those are going to occur while you're alive, right? We can sell these things again to the one generation or your next generation or to some off-farm unrelated parties and get rid of the asset altogether. Gifts, right? Those also occur while you're alive. And then that inheritance, that's going to be, again, through your will or other trust mechanism that potentially will be after you pass on. And we have that basis box in the top there, and we need to explain what basis is, but I think we'll do that again as we move to the next slide. But before we get too deep in the weeds here, where are you guys at, right? In your farm transition and estate plan, do you plan to use the sales, the gifts, inheritance, or a combination of 2 or 3 of these that we listed, right? And we're not going to ask everyone individually on the call today, but we want you guys to think about it. Maybe you haven't really thought about using the gifting mechanism that we'll explain hopefully very thoroughly in the next 5-10 minutes. Maybe you thought only inheritance was the best way to go and you haven't thought about the sales approach. We want to explain all three and show that they might have some useful strategies and be strategic for your personal operation. Okay, basis, right? We talked about this briefly right away, but what is it? Okay, basis is the cost to recover when you sell an asset. And we have some examples to highlight this a little bit more clearly. But your basis, it may change, right? As you take a piece of machinery and you depreciate that via taxes, right? You depreciate your assets over time. That is going to decrease the basis that you have in that piece of machinery. So that's going to become your adjusted basis. Basis, again, is going to be generally determined by how you acquired the asset and how long you've held it. So again, if you buy a tractor for $100,000, depreciate it $10,000 year over year, and the tractor is now 20 years old and you still own it, your basis is probably pretty much $0 in it. Okay. Whereas if you purchase land, you don't depreciate the land. And if you have raised livestock, if they're raised livestock, your basis is going to be $0. So different asset classes have different ways to calculate that. But again, as we continue on here, we have some examples to highlight it. Okay, so again, if you purchased an asset, your basis is the amount that you paid for it, plus improvements, but then you take away any depreciation that you've taken over the life that you've owned it. So again, we have an example here. You purchased a tractor new for $175,000. You've owned it for 10 years. You've taken $98,000 worth of depreciation on it. Again, the adjusted basis for that is going to be $77,000. So again, the math is pretty simple. It's your original purchase price minus your depreciation, and that's going to be your adjusted basis. If you did some improvements to that tractor, right, maybe you depreciated the tractor down to $0, but then you kind of fixed it up, put a new motor in it, things like that. It can increase a little bit as well, but yeah. Some assets, right, capital assets, stocks, bonds, right? If you have some stocks, those also have a basis number, and that's just going to be what you purchased that for. Farmland, machinery, buildings, breeding livestock are not capital assets, and when you sell them, they may receive capital gains treatment, which is going to be subject to this depreciation recapture. So again, we'll kind of highlight some of the things that people need to pay attention to when they go to try to sell things or gift them to their relatives. All right, so again, selling these assets. So when you do sell an asset, there is no stepped up in basis, okay, prior to when the new owner will buy that asset, because there is currently in our laws that we have, if an owner keeps land upon death and gifts it or inherits that to their son or daughter or other family member, that new owner, the son or daughter, they can now have a stepped up basis in the land. And especially for some longer owned parcels of property that maybe have a very low basis, maybe you bought it for $100, $500 an acre 30, 40 years ago, and now that same piece of land is worth $5,000 or $8,000 or $10,000 an acre. You can see there's a very large, capital gains implications on that parcel of land, where that stepped up in basis has a advantage, right? If we can, inherit that parcel of land to the next generation that gets that stepped up in basis, they can avoid paying a lot of property or tax on that property. But we also want to point out, again, with that sale of low basis assets, contract for deed can create some tax implications if done late in life or during that contract for deed, the death will occur. The heirs will continue to pay taxes and principal interest payments on that contract for deed.
Yep, the only comment I'd make there is that reason why it's, you think about that, once the contract read, there's no step down basis anymore. So that's continue, you've set the price, whatever it may be, and you've missed the opportunity for stepped up basis. Okay.
Yeah, that's a great point, Dave, that the contract for deed there, we just want to, again, pay attention. Again, large, right? There's different ways to sell assets, right? Large one-time sales can cause some tax issues for the seller and can also be financially difficult for the entering generation if they're kind of supposed to buy everything lock, stock, and barrel all at once. Installment sales, they can spread the income over the duration of the sale and lower the tax burden. So let's just say instead of, in the first example, if the farm, machinery, livestock, land is worth $1 million, that owner of that land is going to have, $1 million of income in 1 year, right? That's going to be a tax issue. Then also the incoming generation, right? They have to go take out a loan for $1 million to buy the farm. That can be challenging. The installment sales, they can help spread some of that income for the seller over multiple years. Let's just say it's a 10-year installment sale. It may help lower the tax burden because you can spread that over multiple years and be in lower tax brackets. But sometimes machinery and breeding livestock there can be a challenge where they have a bulk of the, capital gains and stepped up, or the depreciation recapture in year one. So the installment sales can be tricky, but they also can be helpful. Just talk with your tax professional about that, but that might be a good fix. Piecemeal sales also can work well. The piecemeal sales are where the farmer or the elder generation is going to sell, a few cows 1 year, a few cows the next year, a tractor 1 year, 2 years from now, they'll sell the combine, where they sell kind of one piece at a time to have the farm transition. Again, that's going to take multiple years, right? You need to plan ahead to have that piecemeal sale work well. Also, we just want to highlight that the crop and market livestock, they can be subject to self-employment tax. Again, there's more taxes to be paid. So we just want to highlight some of the issues that arise so you guys, everyone listening, can plan ahead and avoid some of the, burdens that do exist. All right, so again, we have an example here. We have a cow, right? Selling $20,000 worth of cows, with the unclaimed depreciation of $5,000 there, that's going to result in $15,000 of taxable income. And we have a slide in just a little bit that highlights kind of graphically what we're talking about there. But we do want to pay attention, right? A lot of these, and if it's raised livestock, right, that you raise them from birth, then you're probably going to have $20,000 of taxable income there that we need to plan ahead for to best avoid huge tax burdens that realistically can occur.
So how do they get depreciation on a cow, Nathan? They had to buy it. They had to buy some of these cows to have any depreciation there first, too.
That's correct. Yes, you need to buy cattle to have that depreciation there, because if they're raised, you have zero basis in the livestock. But yeah, if you do buy cattle, as Dave just pointed out, there can be some depreciation. So what's going to happen with taxes, right? This talk today is to highlight some of the tax burdens and again, strategies to help spread the taxes out over multiple years and lower tax rates. It depends on how things are going to be taxed, right? And it depends on how quickly you sell everything. Like we just mentioned, if you sell everything in 1 year, you probably have a lot of taxes to pay. Whereas if you can spread this out over multiple years, it typically is a little more beneficial, but some of those are outside of our control with, personal health, personal, plans and wants and needs about how soon you want to get out of the farming business. So it depends, right? That's not the best answer, but it's the most realistic answer that we can offer. And our next slide here, this highlights this depreciation recapture and kind of what that tax implies. So we can use this. This can be a small piece of equipment. Maybe you have a small yard tractor. You bought it for $10,000 5 years ago. You took $5,000 worth of depreciation over the last 5 years. Your adjusted basis is $5,000, right? That is your purchase price minus the depreciation. So your adjusted basis is $5,000. And then you say, I don't need this tractor anymore. Or maybe you just want to buy a new one. You're going to sell this piece of equipment. And the used machinery market's been pretty hot. You can sell that piece of equipment for $20,000, right? This is not unrealistic for selling more than your purchase price right now. So you sell it for $20,000 today. You have a $5,000 depreciation recapture, right? To get that adjusted basis back up to your original purchase price, $5,000 of depreciation recapture. That's going to be ordinary income, not subject to self-employment tax. And then that additional $10,000 above your purchase price to the sales price that you received is going to be capital gains. So you'll have $10,000 of capital gains, right? And the rates for that depend on kind of your tax bracket, 10 to 15% or so. And then again, $5,000 of depreciation recapture. So that's, again, how some of these things are going to be taxed. And again, that raised livestock, you have zero basis and it'll all be treated as capital gains. And land, you don't have depreciation, so you'll probably be treated capital gains for the entirety of the increase in land sale price from what you originally purchased it for.
And actually on raised livestock, it's all ordinary income. So there's no capital gains. So if you sold a cow that you raised, you're not going to get any capital gains, and that's all going to go with ordinary income.
Thanks for the clarification, Dave.
Yep.
So again, that's kind of how taxes are going to be working on selling assets on the farm. Okay, again, when selling current assets, there is no basis. You can deduct your eligible expenses when selling these current assets. And again, we want to, consider these ordinary income tax rates, self-employment tax. There's possibly the Medicare surtax when selling these, especially if we have a large sale in 1 year that might bump us into a higher tax bracket. So again, we need to plan ahead. That's the point of this session today. Best strategies and methods to plan ahead and reduce the overall expenses to selling the farm or selling farm assets. Okay, again, beware of this depreciation recapture and capital gains. Self-employment tax, right? You may have to pay that on certain asset classes when you sell them. That's going to impact, right? That's going to be an additional tax paid. And if you want to reduce your taxes, you need to be cognizant of that. Talk to your tax professional, have them help you design the best strategy to see what fits your needs, right? How do these sales fit into your broader succession goals, right? Are we selling to the incoming generation that's going to take over the farm, or are we going to sell some of these assets out of the farm business and just keep the cash that comes with the sale of that? So again, we want to figure out what fits into our succession goals and how these steps can fit those goals. Okay, gifting. So that kind of wrapped up our selling aspect. And gifting, right? Gifts can be used. Right? Gifts can be used to start an entering generation into the farm business, right? Maybe you have that $10,000 tractor that we sold in the previous example, and you want to gift that to your son or daughter, right? That's perfectly legal. There are, reasons that it's a good idea to use some of these strategies. Transfer the incoming tax obligations to children that potentially have a lower tax bracket. It can help reduce the taxable estate, right? There's also some charitable purposes behind this. And gifting assets can help with some of these things. And we'll, again, explain this in the next couple slides in more detail. So in many cases, gifts is not going to result in a taxable event for either the donor or the donee. So either the person giving the gift or receiving the gift, typically neither will have to pay taxes on that. Every person can gift up to $17,000 a year worth of assets. So $17,000 in asset valuation per person to as many people as you want to in a given year. So maybe you have a father, he wants to gift either of both of his two children $17,000 a year. So $34,000 per year that the dad is giving his two kids. His wife can do the same thing, give both of their children $17,000. So again, in that 1 year, husband and wife can give their two kids $68,000 per year, right? That's going to be 4 times 17,000 with the two kids, right? In 2022, the gift allowance was $16,000. I believe in 2021, it was closer to $15,000. So this is adjusted for inflation, and it has been increasing the last few years, but for 2023, it's $17,000. Okay, so what does this gifting do, right? So on top of the annual exclusion, there's a lifetime combined gift, estate, generation skipping transfer on the federal side here of $12.9 million. $12.92 million per person here in 2023. So per person, per couple, you can double that figure and get, $26 million on the federal side. So that's a pretty large number. Most farms are going to be less than that $26 million exclusion on the federal side. So in 2022, the federal federal estate number there was 12.06 million. So again, it does increase annually. We do have to look ahead that I believe this number currently as written at the end of 2025, this number sunsets. So we had a Tax Cuts and Jobs Act signed in the end of December of 2017, which had at the end of 2025, this federal exclusion is going to be reduced. I think it's going to be cut close to in half. It'll be around, it's 5 million plus inflation. It'll be around 6.5 million or so come calendar year 2026. So in the future, this number as written, right? Federal rules can change, right? Anything with the government can change somewhat at any given time. But we just want to be aware in the future, this number might come down somewhat significantly from 12 million down about 6 million is a big cut. Minnesota does not have a gift tax, but there are a 3-year, adds back 3 years with that. And again, we'll try to explain that in more detail. So again, as long as you're $17,000 of gifts over the course of your lifetime are below that $12.9 million, there's no taxes paid on the donor. So again, just trying to clarify that. And again, if there's any questions, feel free to throw them in the chat or the Q&A box. So again, gifting here, right? They are going to be valued at their fair market value. The donor's basis is going to go with the gift. So let's just say the donor wants to give their son 1 acre of land. All right, they bought it for $500. It is worth $10,000 an acre today. If they give that 1 acre to the son, their basis stays at that $500. It does not get that stepped up in basis that land can get upon death. But a gifting, no stepped up in basis. If the donor sells the gift in the future, right, they're going to have a large tax burden probably because of that low basis, right? So that's either an incentive or a disincentive, depending how you look at that, to sell that land or to gift that asset, land or equipment, cattle. You can gift any type of asset with gifting. Okay, when utilizing the partnership or the corporation, you can actually gift more value because of discounting. And again, I think we'll highlight that on the next slide here in a little bit more detail. Discounting. So the IRS does allow for discounting. So maybe you, as a family, own a farm business, and it's set up in an LLC, some other partnership or a corporation, and it's a closely held family business. Let's just say that it's the father, his brother, and 1 son, right? So there's 3 owners in it, and potentially they want to bring in the other brothers, another family member into this organization. If we are to sell that farm business partnership on the marketplace, let's just say that we want to go to the New York Stock Exchange like method of pricing, and we want to say, hey, we want to sell, you know, a 1/3 stake or a 1/4 stake of this family business. What's that worth? Right? The IRS understands and puts this discounting in place because having a non-family member buy into this farm business with a 25% stake, they have no voting rights. With a minority stake, they really have no decision making with that minority stake in that business, and therefore the value of that business to an outside member can be discounted, right? That it's very unusual for a non-family member or a non-relative to buy into that family business. And that's the purpose of this discounting. Whereas if a family owns 100 shares of Target or 3M, another large business where the price is clear and decided by the stock exchange, and we can say, hey, that Target stock is worth $200 a share, and that's very easy to find public information. On the farm side, small business side, we don't have that ease of pricing. And with that, the IRS allows discounting. And what that means is, again, if we want to gift the son 1% of this farm business in 1 year, 1% additional in the next year, we can discount the overall value of that and in essence gift more to come up to that $17,000 annual limit. And the discounting is typically 15 to 25% a reduction, a discount for these gifts. You get much over that 25%, the IRS may take notice and may audit you and say, hey, that's an unrealistic discounting amount, and say, we need to look back at that and say, hey, instead of you gifting that, 1% of the business, it really was more like 0.75% because you discounted at, 50% in an unrealistically high discounting amount. So hopefully, again, that kind of wraps around what that discounting does and what it, allows you to do. We have several different stories here with this $60 basis. So this is a true story. And again, this is either an incentive or a disincentive for an older family member. I know that the one story that my coworker had was they had a farmer and they had a bunch of land, right? They had several hundred acres of property that they wanted to keep in the farm. And again, there's two sides of the story. In this first example, this farmer wanted the family to keep this farmland, and he bought it 50 years ago for $60 an acre, and the basis in that property is $60. This farmer purposely gifted that farmland to his next generation, because with gifting it, the basis stayed as is. There's no stepped up in basis in gifting that farmland. And his son got this property with a $60 basis, and it's probably worth, $6,000-8,000 per acre. And with that low basis in the property, that son who just was gifted this property has incentive to not sell it, because he would have capital gains treatment on the entirety of the sale price with that low basis, right? So as that older generation gifting this property, it was incentive for the younger generation to not sell it. Maybe that older gentleman was concerned that his family wanted to sell the farmland, and that gifting somewhat prohibited him from selling the farmland after the gift. Whereas the other side of the story, with a $60 basis in farmland, that farmer could hold that property until death, inherit that then to his son or daughter or whoever's taking over the farmland, and upon death, that would get a stepped up in basis. The step up would be a fair market value at the time of death. So then the basis would jump up to, $6,000 per acre, or whatever the going rate is. So again, both incentive and disincentive, right? There's different strategies with gifting and inheriting farmland with low basis or even high basis. So again, just continuing on with this gifting, we want to document, right? Document all gifts in writing, sign, notarizing the document is a good idea. You want to list the date of the gift, the donor, the donee. So again, who gave it, who was gifted it, what's the fair market value, what's the basis, basis of that gift. Maybe it's a piece of machinery or a truck. What's the make? What's the model? Serial number, a description of the gift. Say, hey, this is a 1994, tractor, whatever the make and model is. Or maybe it's, again, it's a 40-acre parcel, and you can list the county parcel number and say, hey, it's 40 acres, the basis $60 per acre. Right? You want to store these documents in a safe place. And again, we do want to point out that there is a federal form here, this file 709, and that is going to help dictate what the gifting basis and gifting amount was. So maybe you can say, hey, I gifted you this $60 basis land. It's currently worth $6,000. I gifted you, 1 acre this year, 1 acre the next year. Filing that 709 is a good idea, because that sets a price to the IRS that this land was worth this today. Whereas if you don't file that 709, the IRS can look back and say, hey, that land was worth way more than what you listed it as, and that gift should be for a higher value. But with that filing at 709, they have a 5-year look back. So after 5 years, they can't edit and say that wasn't an accurate value. So again, amounts that exceed the annual gift of that $17,000 per year, right? We just want to make sure we track that. So any tax that is due imposed on the person transferring the asset rather than on the recipient. Okay, the IRS can collect a decedent's unpaid tax from those receiving the asset. So if you gift away the farm, but you still own X amount of taxes, they can come to your son or daughter and say, hey, you received all of this property, all of these assets. Your dad, your grandpa, whatever the case is, owed $10,000 in taxes. They can come and get that. So you can't cheat the system with this, but you can lower some of the taxes owed by gifting some of these assets.
To question the chat box right now, and we'll talk about life estates and trusts and wills on the next session. But around gifting, you're gifting that portion of the life estate. So there's a value to that life estate at any point in time. So that's the question on the chat box about around gifting a life estate from a basis perspective. So if you want to go any farther, Nathan, with that, you sure can.
I think you answered that appropriately. Again, you're gifting your basis in that life estate, but as you mentioned, we'll go over some of the life estates in more detail next week. There's potentially a raised hand. If someone has a question, feel free to throw it in the chat box or the Q&A. Okay, so another question came in. Dave, you're muted, but I think you're trying to answer the question about if you have some equipment that's depreciated to zero, how does that impact a gift?
So Nathan talked to you about fair market value. So whatever you give for equipment, you have to establish the fair market value of the date of the gift. So you either go have it appraised, you go to the implement dealers, figure out go to an auctioneer. What's this Bobcat worth? What's the skid steer worth today? Even though depreciation is zero, you can only give $17,000 a year under or less of value to not have to worry about estate tax issues or lifetime gift tax issues. So that zero depreciation is only for income tax purposes, not for estate or gift tax purposes. Hopefully that answers your question. All right. So we got a Q&A in here too. So the question there is, does gifting use up some of the estate exclusion? So the question there is, you're gifting, if you're $17,000 or less, any individual in any year, it doesn't affect your exclusion. Once you go over the 17,000, that amount, like Nathan talked on this slide here, that 709 form is required to be filed for anything over 17,000. That starts coming off your federal estate tax amount. That's 12.92 million. But if you're 17,000 or less in 23 to an individual, it doesn't affect your exclusion. Okay. You want to answer this question, Nathan? That says, so I gift land with a basis of $500 an acre to reach the annual gifting. Do I use the $500 an acre for present value?
You would use fair market value.
So the basis goes to the gift. So the $500 would be your heirs, wherever you gift it to, basis. But if you want to stand at $17,000, if Nathan talked about $6,000 to $8,000, $10,000, whatever that fair market value is on the day of the gift, is what you would have to account for the gift, the estate taxes part. Okay. I think there's one more. Are you all done there? All right, we're all done with questions. All right, so feel free to answer those questions. We'll just interrupt and we'll answer as we go.
All right. So also, we only talked about the federal side so far. We really haven't talked much about the state side. Dave will talk about the state side, the next 10 minutes or so. But we do want to pay attention and throw out that there is a 5-year look back for medical assistance. So let's just say that you're a farm family, you gift your son a whole bunch. You gift your son a whole bunch of property, and then you need to go into the nursing home and you need medical assistance. Again, the state can use a 5-year look back and say, hey, you gifted your son this farm land for, they can potentially have some of that paid back to help with medical assistance. And I want to make sure Dave clarifies if I said anything inaccurately.
No, there's just a question in the chat. It just popped up. Can you about the $12 million exclusion right now, or 12,092,000. So if you gave the gift right now with a $12,920,000 exclusion, and it goes down to 6 and 26 or whatever we talked about, you will still get whatever. When the gift was made, the $12 million will stand in place. But if you gave a gift in 26 and it was $12 million, then you'd have estate tax issues, because if the exclusion amount was $6 million in 26, you don't get the $12 million amount if you give it then. But if you give it in 23, well, there's a $12,920,000 exclusion, you'll be fine. That won't be affected by 26 when it goes down, if it does go down when it sunsets.
But then this is a lifetime gift. It's a summation of all your estate worth upon your timing of death. So if you do die, in 25, right, there's nothing to worry about. But if you die after we have this reduction in federal estate, that probably will increase with the decrease in the federal exclusion amount, right, at the time of death. It's just the summation from all of your previous years.
But the question there about the 12 million, when she gave the gift in 23, she used up her exclusion, or he. In other words, when you die down in 2040, it's only $6 million exclusion. That won't matter, because you actually gave your lifetime exclusion amount up and used it up in 2023 when it was set at 12 million. So there won't be you won't get it taxed again back in 26 beyond, because when you did the gift, you used up all your exclusion amount. So when you die, if you have other assets when you die and they've accumulated from 2040, whatever you've accumulated since that gift will be taxed. 100% taxable, because you already used your exclusion up in 2023. We have one more question up here, Nathan. It's about discounting.
I don't quite understand. Can the partnership be family informal, 20% to me, 80% son, to claim the discounted value?
And the answer would probably be no, because what he's saying is not a formal partnership. And when you were talking about discounting, you're talking about corporations and different things where you have a minority voting rights and different things. When you have an informal partnership, there's nothing really to go along with that restrictions. So the answer, if you have an informal partnership, I would say no, you probably can't discount the assets.
I agree with what you said, Dave.
All right. Okay, so let's go back to our session here. So on next slide, or what would you like, Nathan?
Yeah, I think we're next slide here. And this is a recap here again. Typically, gifting does not result in tax to either side, right? There's our exceptions. There could have some financial consequences for the older generation if they underestimate their monetary needs, right? Maybe in the future they need more money than they anticipated, and we would just want to plan ahead to avoid unnecessary gifting. And again, how do these gifts fit into their broader succession goals, right? Do they want to keep the farm in the family? And maybe gifting will help with that, right? They can give their sons or daughters or grandchildren, some ease of getting into the farm business with gifting. But maybe again, that's not the best strategy. So again, it all depends on what fits your personal family and your personal business farm goals. I think with that, Dave, you get to wrap it up.
Yep, so I just would give you a comment, when you do a chat box, it tells, when you post to it, it says everyone or the panelists. So one person said he can't see the other people's questions. That's how they post it on the chat box. You have to say to everyone for everyone to see it. And so that's why it doesn't always work in the question. The Q&A is just for us. So that's why you want to use a chat box for everyone to see it. Okay, the question. Otherwise, I'm trying to repeat them as we go. Okay. But again, feel free to ask your questions, preferably in the chat box. So if ownership transfer isn't desired at this time, so you don't want to turn over the assets, you're not sure that that's what you want to do today. You know, it's not the tool you want to use. Leasing can be a good option. You know, we don't want to have a buyout clause at the end. You want to have just a lease. So you can just take that lease income, and the next heir farming generation can take that 100% deductible as expense. So leasing is a good thing. Machinery only leases are self-employment tax because it's a lease. You know, it's ordinary income. It's not a capital purchase. You're not selling it to them. And you may want to combine your leases. So you put them all in one place and have them all together, and just not a lump sum of leases. You might want to include your land in the lease, different things like that. So you don't have to separate it out and treat it like a rental income. So that's where you might avoid some of that self-employment tax. But again, it's up to you as a seller, you know, the farmer, the older farmer generation. If you combine the leases, maybe that all isn't subject to self-employment tax, because rental income is a little different than the lease on the farm equipment. So you can think about those different tools. And again, we always tell you to go see your professionals. When you look at these different options, go see your accountant, tell you the idea you want to do and why you want to do it. And, you know, attorneys are expensive, but they're worth their time too. Different questions, you know, ask your peers what they're doing. Ask them what they've been done. You've got people you trust and talk to probably every day or every week. Just ask them questions about what they're doing and how it's working for them. There's lots of inheritance transfer mechanisms. We talked about those 3 different tools. Well, you can have wills. A lot of people have wills. We encourage everybody to have a will, because a will is a letter to the judge what you want to happen to your assets. So that's instruction. Without a will, the state has a will for you. So if you want the state to take care of your will, you can leave it up to the state and they'll take care of it for you. But I encourage even young people like Nathan and to have a will, and especially when they start having kids, because that will can include who's going to take care of the kids. They both get in a car accident this weekend. You know, those things are important to have that decided. If you want to decide that, a will can direct that instruction. So the wills have their place. I encourage everybody to think about having at least a will. Then we have testamentary trusts, and there are all kinds of trusts. And we'll talk more about in the next session about trusts. And there's lots of ways to go around those, but a trust allows you to kind of put more emphasis on your assets. You can control those assets beyond your grave a little bit. You can say how you want the things handled in the future after your death. There'll be executor of your estate and administrator of your trust, and they'll hopefully follow what you have in their guidelines for your trust rules. Also, another inherent mechanism is today you can go out and put beneficiaries on your life insurance policy, ownership designations on your checking accounts, on your stocks, investments, even on the transfer on deed at death, TODD, on the land. So there's lots of ways you can just transfer it right away automatically, and you've already set it up. So there's no argument that'll trump any of your wills or trust documents, because they'll have ownership upon your death. All they have to do is prove death. Whenever you have beneficiary listed or ownership on those documents, it'll go right to whoever they are. Transfer via inheritance will almost always result in a stepped up basis. So in other words, like Nathan was talking about earlier, if you hold the asset until you die, and again, we have the nursing home issue versus dying and hold it till you die. Once that gives you the opportunity, if you have it control in your name, even in a trust, you'll get a stepped up basis to the fair market value under current law. That's a very positive thing. So if your heirs decide to sell after you die, they would pay no tax on that sale price. There still could be estate taxes, but we're talking about income taxes going forward. Irrevocable trusts function more akin to a gift and therefore not get stepped up basis. So the difference between a regular trust and an irrevocable trust is I don't control his assets anymore. With normal trust you set up, they're called revocable trust most of the time, or irrevocable is the other kind. Revocable, I have control and I can change the tools. I can change how I want to see in the future. With an irrevocable trust, it's set up and done. And I don't have any control of the assets anymore. I'm not going to be able to modify it. So once I set it up, it's really going to fall outside my estate and therefore it doesn't get set up basis. So we'll talk more about that next week too, as we go forward. There's another tool out there called special use valuation. I got another question in chat. I'll look at it quick here. What are the negatives and positives of transfer on death? I would say the positives are it automatically takes to wherever you, if you know where you want those assets to go at transfer on death, they're going to go there automatically. It's done. If the negative of it, well, maybe when you set it up and when you died have changed. And so you want to make sure when you do the transfer on death documents or paperwork that you're comfortable with that until the day you die, or might get divorced, you might have grandkids, you might have different things, you might want to change things. So you have to keep monitoring those things. That'd be a little bit of negative to make sure they're current. Have a hand raised out there. Could you put the chat box in there, Gary, if you want to put something in the chat box for us and we'll answer your question. Otherwise, I'm going to keep going. All right. So special use valuation, another tool. You'd only want to use this if you have a taxable estate. So Minnesota, with a farmer, you're farming until the day you die, you have a $5 million exclusion. Individually have 3 million, everybody has 3 million, and you can get additional 2 million if you were farming on homesteaded ground the day you die. Okay. So if I have less than $3 million estate in Minnesota, I'm not going to use this tool because it's only going to help reduce my estate tax value of that value of my estate in versus estate tax calculations. So, but you can use it if I have a taxable estate. I might use this tool to lower my total estate by using this tool, and you get to use the real estate taxes on the property, the 5-year average, and the agribank interest rates, 5-year interest rates. Figure out a calculation, and instead of being that calculated $10,000 fair market value on the date of your death, you might get a $2,000 acre reduction. So then you're using the fair market special use valuation, you get an $8,000 valuation in your estate instead of a $10,000. So you save $2,000 an acre. So that can lower your estate taxes. I have another chat question up here. With TOD, can you specify per? What's she saying, Nathan? What do you think this ST?
I don't quite know if Jeanette, if you could reiterate, specify per strips. Stripes. I don't.
With transfer on deed, you basically you can put on there, or transfer on death. I'm sorry, you said transfer on death here. Like I've seen people put all their kids on there, so they all have ownership on that account. It'll get divided 4 ways or 3 ways or 2 ways, whatever you want to do. However you set the transfer on death document with the institutions, most institutions like a bank or a financial planner or stockbroker are going to have their own documents you fill out, and then when you fill it out, you're going to put on there who's going to be listed on the transfer on death. So that's kind of how you clarify that. Okay. Yep, you can have means answers. So I have to go to my grandkids. You can say I want to go to my grandkids. Yep, if my kid's already dead. But again, when you do the TODs, transfer on death, you're going to go to the institutions and fill out their forms, and they'll tell you how to do it properly on those TODs. Okay. All right. So anyway, by using a special use valuation, again, you're only going to use it if you have a big taxable estate. Like I know a family has 5,000 acres of farmland in southeast Minnesota. Well, they're going to have a really large estate, aren't they? So they might want to use this tool, but again, it's not necessarily for everybody. And what's the heirs tax basis would be the same as a special use valuation. So instead of being a $10,000 basis for the kids, it'll be the special use valuation $8,000. They're going to be their basis because you use that tool to lower the estate taxes. Federal state taxes are assessed only amounts exceeding the federal state tax exclusion amount, like we just Nathan talked about. It's 12.92 million. In 23 it was 12.06 last year. So it has to be above that level to get a federal estate tax. You have to have quite a bit of assets, and that's per individual. So husband and wife each have their own exclusion amount. So you can have quite a few amounts of assets to be non-taxable. The credit of the act is on the exclusion amount. Basically, the credit is the actual tax on the exclusion amount. So the credit shows up, and you look at the websites or documents. We show some documents. We have a credit listed. That's just the exclusion amount. That's for different levels of taxes. Exclusion credits per person are per person. In other words, each individual has that. And like we just showed, they vary by year based on law and inflation. Right now, the inflation went from 12.6 million to 12.92 million for 23. Again, we talked about the sunset law in 25. So it could change with inflation adjusted. We don't exactly know what the number was going to be right now because we got a few years to figure that out till 25. But any unused exclusion is portable to the spouse. So that's another interesting thing about the tax. So I have a $8 million estate. Okay, and usually the guys die first. So I'm not going to give any of those assets to my wife because she's already got her own farm. She's already got her own assets. She's got a $10 million estate. Okay, so I'm not going to give her anything. My stuff's going to go to the kids. But I didn't use $4 million of my federal exclusion, 4,009.92. That's portable to my spouse. So if she died next year, and like there was some couple just the other day died the same day, which is really interesting. They died within hours of each other. It was just from the news the other day. But if you die usually within, I think it's like 17 months, usually spouse dies after the first one dies. It's kind of that love story, you know, they died after that. But anyway, so my spouse dies next year, but her assets have increased because land values have jumped dramatically now. So all of a sudden she's got a $16 million estate. But because she had a $12,920,000 plus the portable $4,920,000 for me, all of a sudden she's at over 17 million. So even though she would, because mine was portable to her, so they would have no tax pay on her estate when she died next year. Have another question? What is the Minnesota state tax exclusion? We are going to get there, but basically the Minnesota state tax exclusion for everybody personally, whether you're a farmer or not, is $3 million today. So everybody has that. And there's additional $2 million up to $5 million total for, and that's why it's the reason why I say $5 million total, because the Minnesota has been changing over the years. But so you have another $2 million you can potentially get from the state. We'll talk about that too down the road a little bit. So anyway, this portable part is a nice thing to have. So it allows the second spouse to die to have a bigger estate. We're gonna do question and answer. Okay, I already did that. All right. So Minnesota has that lower estate tax exclusion. You just asked the question. The amount that's transferred free of tax from the Centenaire, it is that federal government, is it lower than true or false that our amount transferable free to the Senate on the air is true or false that our Minnesota has a lower estate tax? Well, I just told you the answer, didn't I? So I really kind of beat the poll because of the question, but we do not, it's a lower number. So I have a lot of people thinking about, because we don't have any gift tax rules. So some people are actually going out and trying to get their estate to below the federal estate tax exclusion amount by gifting. So you can do, there's lots of tools you can use, different recommendations, but again, see your professionals. Okay. We're gonna go on. So Minnesota has its own estate tax. I can remember it was 600,000 was the Minnesota exclusion once upon a time. 600,000. Okay, well, I've been doing this for 20 years, but it's been gradually increasing. It's been it used to be 1 million for a long time, and now it's 3 million. Everybody has, but the impact on estate tax will vary upon the value of your assets, type of your assets, and the provisions of your estate tax. So even though you might not need federal estate tax might be old, you still might owe some Minnesota estate taxes because our threshold is much lower in Minnesota. If you do have Minnesota estate tax, they're taxed at 13 to 16%. So it's a progressive rate scale at first. So that first dollar over $3 million estate for 3,000,001 is taxed at 13%. And as you get more and more income, it's taxed to where you get to a certain scale, it's 16% all the way out. So Minnesota has a personal property exclusion of 3 million as of 2023 and beyond, until they could change it anytime. They're talking about balancing our income tax and exclusions for the federal government this year. That's the new thing on the Minnesota docket this year. But they really haven't talked to me. I haven't heard anything about estate taxes, but and on top of that, you can get a qualified farm exclusion of on your farm property of 5 million. So the 3 million comes out of there if you use the 3 million first. So really we're talking about 2 million. So that a total of this is personal qualified property exclusion. So what's this qualified property exclusion? Well, in the taxable year of your death, so if you die in 2023, and your property was classified as 2A with ag homestead, or ag relative homestead, or special ag homestead. So if it's got a homestead qualifications, and you were actively involved in that farm when you died, and that was in your name, then it's going to qualify for this qualified exclusion. I got another chat question here. The exclusion, Minnesota exclusion, is whenever the person dies, is a question. They say, is the Minnesota exclusion good for 1 year or the inheritance lifetime? The exclusion is good at the date of death, whoever dies, so that whenever they die, that's in effect. So it's not going to ever be changed. They'll get everyone else, we die, we're going to get $3 million today exclusion in Minnesota. And then we get the ag homes or the Minnesota qualified farm property exclusion on top of that, up to $2 more million, for a total of $5 million. That's gonna be this how it's written today. So it's gonna go on. It's at one point in time. So it's not gonna be subject to a Minnesota estate tax. So if my estate is $3 million less than Minnesota as an individual, so I got $6 million tossed as a couple, it's not gonna be taxed at all in Minnesota. And if I have a $10 million estate as a husband and wife, and we each own half the assets, we each have $5 million, and 2 million of that's farm assets that are in our homestead in our name, we can get up, potentially have a $10 million estate in Minnesota's couple that won't be subject to any estate taxes. So when either one of us die and our levels below 5 million, we have farmland that's qualified farm property, there'll be no Minnesota estate taxes. But really, we're more concerned about Minnesota estate taxes right now than we are about federal, because of the starting point of 5 million or 3 million in our situation. Okay. Great. So after qualified property, this whoever dies had to continue to own the property, this qualified property, for 3 years prior to death. So as long as they had it, they're retired farmers, or and 3 years after death. And once you die, whoever inherits the land, family members, must maintain it as 3A property for 3 years after death. Now they've kind of made it a little easier. You don't have to have homestead anymore, but you have to keep it ag property. So you can't develop it, you can't sell it to a developer, you can't sell it, period, in that 3 year time frame. You've got to keep it ag land after you inherit it for 3 years. So that's part of the process to keep the qualified farm property exclusion. You get that additional $2 million of again, like it says right there, the heirs do not need to keep homestead or actually farming land. They just have to keep it in ag property. I think I might have another question up there. Let's see. Okay, so now we got a question in the chat, or the question and answer is, what is the prime property as a family limited partnership or LLC or trust? The partners out of the state. What is the Minnesota state? So first of all, I tell you to talk to an accountant about your different scenarios and your different setups. So if it's an LLC or FPLP, and the partners are out of state, they're not going to have homestead property probably on that property. If it's in their name, their assets, they're not going to be homesteaded. The farm can't be homesteaded if I own part of that property, period. If I'm farming together with a farming heir that's in the state, I really couldn't answer. I don't know the question how that would really work very well, because again, it's got to be homesteaded. And if I'm out of state person, is it going to even qualify? And that's another for your, each county has their own viewpoints on what's homestead and what's not homestead, and also your accountants and also your attorneys are going to have all different opinions on that. So I'm not going to answer that maybe like you'd like me to answer today, because I would tell you see your professionals, because all those different things have different. Family limited partnership or LLCs, if you own it, I think you would also be very fine with that. Minnesota states are not portable, it's only federal. The next question on there, that's the portable part. And but I would tell you on the FLPs and the LLCs, normally that comes through your income tax. And if you had that set up where the land was in your name, I think we set up not in your individual name anymore, but if you can, if that entity has, but I don't know about the non-part, if you don't live in the state anymore, I don't know if you can ever get the homestead remade. That's the question I have for that from Kent and Chris. So again, the Minnesota state taxes are not portable. All right. So after death, the heirs do not need to keep homestead, but they had to be in homestead before when they died. So day of death, I had to have homesteaded property. Recapture tax. So we've been doing this for 20 years. I've had people at workshops, and their son was in New York, their daughter was in Florida. And they did this, they used the recapture tax. Mom and dad had the farm and they were homesteaded. So when they died, they tried to use it to save some estate taxes. But after 2 years, the son wanted his money. He didn't want to farm anymore. So it forced the daughter to sell too. If you sell it and you haven't maintained for 3 years in ownership after you died, or after the seed had died, you're going to lose that classification. You're going to pay a 16% tax on what anything up to the $2 million used for the exclusion. So that's something to think about. So that kind of encourages the heirs, if they use the exclusion or the qualified exclusion, to be not to sell it within 3 years after ownership. So how much can you transfer of your state tax free under current law? Today, 2023, federally, it's 12.92 million federal level, and up to 5 million at state level with a qualified farm. And again, that qualified farm, we kind of went over the rules, but the biggest factor, you got to have ownership for 3 years prior to death, and it's got to be homesteaded. Okay. Again, is depending on your definition, a lot. Why is what's the taxable free under laws? Laws do change. The federal amount in law was sunset in 25, returning to talked about Nathan. Down the road, and with our inflation rate today, it might be a lot more. Who knows where we're going with that number? Okay. So, what are the federal and Minnesota state tax and gift tax rates? Well, federally, the state tax and gift tax rates are 40%. So if you get above the 12.92 million today, and you give more than that, you're going to be taxed at 40%. And the same with your estate. If your estate's more than 12.92 million today, you die in 23, that the maximum rate is going to be 40%. Minnesota has a scale, progressive scale. It starts at 13, goes 16, and we have no gift tax. But there's a 3-year look back. So if you give a gift within 3 years of your death, it's going to have value of that gift and be put back into your total estate value. And again, I would clarify that if you give $17,000 or less, they're not going to worry about it. It's the only thing you get for more than that $17,000 per individual that's going to be counted toward that. So that 3-year look back's going to be fine there. Another question. If you are gifting annually now and plan to after 2026, which federal lifetime gift limit applies? So in 2026, whatever current law will be, which we just talked about, it'll revert back to the sunset. If Congress doesn't do anything, keep your current exemption in place, it's going to go back to 5 million plus the inflation factor. Okay. So in 2026, that federal lifetime gift limit will be reduced to whatever the federal level is. But the good news, if you do anything now, and you have started to use up some of your lifetime exclusion, it'll be fine. You're not going to be penalized. They're not going to say you already gave away $12 million now. You're not going to owe taxes on that down the road. You're just going to have everything's going to be taxed from day zero, from 0-1 on. If you gave away $12,920,000 today already in the past towards your federal estate taxes, you give up your lifetime exclusion, then $1 will be taxed. If you haven't used up your exclusion and say you've already only given up $6 million of your federal estate taxes, use that in your lifetime exclusion amount, and we get to 2026, a new level of $6 million, well, then your annual gifts are going to be taxable at that point. But it's still going to be anything over that base level, whatever it is. Like today it's 17,000, it might be 20,000 down then, I would guess, or something like that. So there's a lot of things here. And again, you're asking technical point questions, which is good. Everybody wants to know those answers, but I'm not an accountant, I'm not an attorney. We're just giving you a broad concept. I got another question up here. Okay, they want questions answered, but sorry, I can't do both. I don't think I'm in my process here. All right. So let's talk about that. What's included in your calculated gross estate? Well, both probate property and non-probate property is included in your gross estate value. What we mean by a probate, if you do a will, everything you own, if you don't have these transfer on death deeds or transfer on death documents or transfer on death deeds, everything you have a will is going to go through probate. Okay, if you have there's a threshold in Minnesota, if you have more than that asset, it's going to go through probate. Non-probate property will be excluded from your gross estate. So in other words, if you have transfer on death, something like that, so they won't necessarily be included in the total value of your estate. But the seed and share, when you die, the joint tenancy property, so it's 50-50 husband and wife, or your 3 siblings and you own a third of it, whatever you own, that joint tenancy property is going to be valued in your gross estate. It's also going to step the basis on that 1/3 of the value. If you're a sole proprietor or share tenancy in commons or share community property assets, your share of those assets are also going to be included. And if you have life insurance proceeds, they're not included. If you properly owned life insurance proceeds are not included. The only way they're included is you don't have a beneficiary. You own the policy and you get the money when you die, then it's included. So you want to make sure you have an heir or you have somebody to benefit from that, in that life insurance policy. But if you own it and you have it going to yourself, and then you say, in my will, I want that to go to the non-farm heirs, you can do that, but that policy is going to be included in your estate too. So again, you want to think about that in your transfer issues. Allowable deductions. So when you're doing your calculations, any funeral expenses, any last medical expenses, administrative legal fees, any debts to the estate, any claims, you can, in your will or in your documents, if you have, used to have I love you wills. So I love you will would say, here's the federal Minnesota exclusion is 3 million. If I die first, I get 3 million exclusion, everything else goes to my spouse. And I gift my spouse. Well, that would make my taxable estate for Minnesota. I give it away to her. That'd be allowable deduction if that was in my documentation or already had done that. Generally, amounts to qualifying charity, if you're listed in your documentation, to allowable deduction against my estate as well. So there's ways of playing around with these numbers. And again, you got your professionals to go out to help you get these things done. So again, to review some of these tax issues. When I do sales, I'm going to do them while I'm alive. When I do a sale, it's not in my control when I die anymore. Therefore, it's not going to get stepped up basis. When I do that sale, it's going to be subject to income tax, either ordinary or capital gains. If I've got all depreciated out, it's going to be probably most time it's not going to sell for more than I paid for it. So it's going to be ordinary income. If I have capital gains, sometimes real estate might be that, then there's usually a lower rate. Gifts, I'm going to do gifts while I'm alive. I can only do it while I'm alive. Basis carries over with the gift. So a lot of times if we gift an asset, we pass the tax on to the next generation. There's no tax due at the time of the gift. But if the next generation decides to sell it, they're going to pay the tax, you know, what the basis was for you. That's going to be their basis. And so when they sell it up here, they're going to get to pay the tax. You pass the tax on to the next generation. If you wait and tell your inheritance, you pass it on at day after death, that's a positive for the next generation. You get a stepped up basis and possible tax possible, but exclusions are high. So you might not have any estate taxes. So that's a good tool. But why don't we use that tool? Because we're all worried about nursing home, taking away the asset before you get there. So you have to think about that. And again, talk to professionals. Minnesota, really, if you set up a trust or will today, you're not protecting your assets from nursing home. So you have to think about that. If you just set up, so you've got there's only one exactly free way you can do it today. Today, I'm going to gift everything I own to my kids. And I got to live 5 years before I go in nursing home. But what I live on for 5 years, I gave everything away. So, that's about the only way you can avoid the nursing home. And when I give everything away today, what's the basis for everything I gave away today? 0 or low. And then my basis goes to the gift. So I pass that income tax burden on the next generation too. So you have to think about all these different things when you're doing your decision-making process in the transfer process. Be a good consumer of legal and financial advice. They're out there. There are teams out there. There are groups like financial planners, bankers, insurance agents, accountants and attorneys that work together. Sometimes they already have their teams established. So when you go visit one, they'll say, well, I think you should go see so-and-so. And so I think you should see so-and-so. You got your team right there that'll give you those services and help you work together. You want to do some careful tax planning in the process with a skilled professional to avoid some of these mistakes. Because all of a sudden you think, oh, I've done this really well. I've done this. But what about that depreciation recapture? What about these different things that you might not think about? Come back and ordinary income. Or like Nathan said, I get to that big sale year, and we sell a retirement auction, and we have everything go to the auction, we make lots of money. And I get to pay additional tax over here that they've Obama tax surtax on there, which you don't even think about when you're doing your planning. So again, a good professional can help you in that process. Here's our contact information. This is our cell phone numbers. This is the website for farm transition, where you can find just farm transition information. And I've got a couple questions in the chat, and Nathan and I are going to stay on here, but I'm going to repost the link to where you can find the PowerPoints in PDF. The recordings are going to be available. You have questions out here. We are going to put these online. After it's done, it's going to be in the cloud. And I've got one of my coworkers are going to post it online for us. And then they'll send you a link to that posting where you can watch these. There's the first session. This one's going to be recorded, and I'll do the last two as well. The next question on here is, if I do a transfer on death, would that prevent nursing home? And the answer is no, because it's your asset when you die. If you still have the asset when you die, though, you probably are paying your nursing home bill as you go anyway. So unless you had an IOU at the nursing home, they didn't know about this transfer on death at your checking account, or you had a stock investment somewhere else, or you had a CD someplace, that's still going to come back to be liable if you had an IOU at the nursing home. Okay, to answer your question there. But Nathan and I are here. We're going to stick around for a while. We said be here for a couple hours. And so you're sure welcome to send us questions in the chat box, and we take any more questions you might have. Otherwise, we've got 2 more sessions. You're welcome to chat next 2 Wednesdays and join in for the different topics. If you are done with us today, you can just hit the leave meeting button and you're gone. But otherwise, we'll stay here and we'll answer any questions you might have. Got another message here. So Nathan, put your mic off mute, and you're welcome. And we'll answer any questions we can both talk here if anybody has questions. Otherwise, the link is in the chat box too, for where you can find the PDF files. And again, we're going to send you out. If you have raised hands, you want to talk, I guess you can do that, or else we can, I can give permission to talk if I find your hands here. Let's see where they are. I don't see who's got raised hands. 3 of them have raised. Okay. I'm going to allow the 3 of you that have raised hands to talk. So you're going to have to unmute your mics if you want to, and then you can ask questions and we'll answer them as we go. So I see Doug took his mic off mute. Margaret and Carrie still got her mic, or his mic on mute. So Doug, you have a question?
Yeah, when people are setting up farm estates, do they sometimes state a price for the land that's going to be going to the heirs?
So if you can do that. I have an example of a gentleman who farmed for after high school. He was with his dad for 20 years. He farmed a dairy for 20 years out of high school, through high school and beyond. And then they decide they're going to sell dairy cows. So 20 years after he got in the farming operation, he decided he got a different job. He's worked off the farm since then. But when they decided to divide the farm up for not get rid of the cows, Dad, in his will, put a price in there. Like $1,200 an acre was a price the farming son could buy a farm for. And you can do that if you want to. You can put whatever price you want in there. You understand that it could be considered a gift to the heirs, and the heirs can hire attorneys to fight it too, but that's you can, but hopefully they'll respect your wishes and your will, and you can put whatever price you think's fair. You can put it's really doing a trust, because in a trust you're going to direct whoever executive of your trust is going to carry out your wishes as well. So you can say who can buy what the values are, how can I sell it. You can also say I'm only going to let family members buy it. So the outlaws, I call in-laws and outlaws. You know, the outlaws are the spouses of my kids. So the in-laws You have to decide how you want to do it, but you can do that. So there's lots of ways to do it. So you can set a price. I went too long in your question, probably does. Carrie, you have a question? Go ahead and take your mic off mute and ask your question. Carrie, you have a question? How about Margaret? You have a question?
Did
Oh,
you
there.
elaborate much on LLCs?
We do we used to, I gotta think about next sections, but the LLCs are really set to try to protect you from lawsuits. Basically, what's the purpose of an LLC? And you set them up, they're protecting that, but the assets that are in the LLC are still subject to being sued. So if you're a farm family and you have everything in the LLC, you've kind of defeated the purpose, haven't you? But if you have
Correct.
an LLC and you keep your real estate out of that, and it's keeping your name, and the LLC only owns the equipment or only owns the livestock operation. One of the LLC property would be probably if one of the owners of the LLC or the workers of the LLC cause something to be sued for, those assets are going to be still liable. So you protect some assets outside the LLC. That's why you set the LLC.
I know I've been reading a little bit about like people with lake property have put their lake cabins in LLC as a means of transferring that property somehow ahead of death, but
I don't know if that's really it's probably a way they can share, they can do a limited liability company or corporation, either one, but I would say that they're doing that to also protect that cabin, so it's not part of my, that cabin is its own asset by itself, and nobody's gonna really working for that. They're not gonna sue that asset, that asset's outside in that unique entity. So I doubt that it'd be sued for, if you were driving, you killed a doctor today on the way, on traveling, well, there's a big liability you occur from doing that accident. Okay?
got it. Thank you.
You bet. Carrie, you still have a question or not? If you do, you want to take your mic off mute and ask your question.
There is another question in the chat, Dave, about.
All right, there's two questions. I'll get to them. We're talking about that one already. I think I've seen that one. Let's keep going down here a little bit further. All right, so what if the $12 million gets, let's work with that one.
It
The
says
recordings
that
will be posted again online. The slide sets are already out there too. I put that in the chat box, the link for where you can find the slides, but you'll get an email from one of my coworkers, and they'll send you out where you can find the PowerPoint recording and find the handout again later on. So that'll be available to you later.